talk about a shiny metal which has been grabbing investor interest, especially as an investment opportunity. Gold has been giving good competition, I would say.
It's been like a one-way journey for gold for last 20-25 years. Gold is an international commodity. The prices are not decided just by Indian investors and traders. The international trading in gold is happening in dollars. So the rupee dollar parity has an impact on gold price. Nothing wrong in it, because that's the secret, why Indian families...
Maybe gold touching even 1 lakh mark in the near term.
The global financial crisis happened, Banks' existence came in question, a lot of companies defaulted, equity markets crashed world over, or enough gold at that price. And when they stopped buying, the gold prices came down. Indians are benefiting more from this gold price surge than anybody else in a developed world.
We hear about these sovereign gold bonds. What are they?
Gold is the second highest commodity that we import. People need to keep in mind what happened in 2011 or 12.
Would you be able to elaborate that a bit more in terms of how does that impact the gold prices? Hello everyone, welcome to another episode of Beyond Just Returns. Today we're here to talk about a shiny metal which has been grabbing investor interest. I have with me Mr Raghvendra Nath, the MD of Ladderup Asset Managers, and we're here to talk about gold as an investment opportunity. Hi sir, welcome.
Yeah, thank you, Upasana. I'm glad to be here.
Perfect. So gold has been in the headlines for some time now. And especially as an investment opportunity, gold has been giving good competition, I would say, to even equity markets. What is your view on that? Why is that happening, and what is it that you witness now?
So, gold indeed has turned out to be probably one of the best investments that people have done in the last 20-25 years. In fact, most of the women are gloating over their investment decisions when they force their husbands, or they themselves bought gold at various times, and because it's been like a one-way journey for gold for last 20-25 years. There have been obviously certain bumps, but if you invested in gold, let's say 20 years back, I think you would have made as much money as if you would have invested in a good quality equity portfolio. And both the things happened during this period, especially in India. The one is that because gold is an international commodity, the prices are not decided just by Indian, investors and traders. It's a global commodity. So whatever is the gold price internationally is where gold is traded in India as well, bought or sold. But because the international trading in gold is happening in dollars, so the rupee dollar parity has an impact on gold price. And in last 20-25 years, rupee has depreciated substantially against the dollar. Nothing wrong in it, because it suits India, because India has a trade deficit, and therefore India wants to keep exporting more and more. And India's export competitiveness, somewhere is linked with how is the Indian rupee vis-a-vis dollar.
True.
If Indian rupee is weak, the export competitiveness is better, and therefore it has suited India that rupee kept on depreciating over the years. But just imagine that rupee used to trade at 39.40 to a dollar, and now it's trading at 84-85 rupees to a dollar. So if the gold has doubled in international prices, it has quadrupled in rupee prices, rupee terms, and then that's the secret, why Indian families, who have gold as an investment or substantial part of gold, they have done so well, in this period.
Interesting. So we hear about speculations or projections of maybe gold touching even 1 lakh mark in the near term. What is the reason for this recent rally?
Yeah, so in fact, if I were to just give you a little history, and uh, gold was trading at around $500-$600 in 2007-8. I don't remember the equivalent rupee prices, but I think that would have been maybe 20, 25, 18, 19,000 rupees, I think, at that time. And then post the global financial crisis happened. Banks' existence came in question. A lot of companies defaulted, equity markets crashed world over. And in that period of uncertainty, basically gold, which is always considered as a safe haven, so every time the world goes under some uncertainty, goes through some uncertainty, everybody starts gravitating towards gold. So gold prices started inching up, and because dollar was under tremendous pressure at that time, in the entire global financial crisis broke out in US, and then it spread all over the world. So dollar was under a lot of stress, and central banks at that time had started buying gold furiously. And because in the previous 20-25 years, you had removed the gold standard. Earlier in 70s, there was a gold standard. So the currency's strength was determined by the amount of gold reserves that a country had. But then the gold standard was discarded,
Right.
and therefore no central bank had enough gold. And so 2009, suddenly people realized the fluidity of the situation, and central banks started buying. And that $600 in a matter of just 2 years went to $1,900. But that, at some point in time, people realized, even the central banks across the world realized that they now have enough gold, or enough gold at that price. And when they stopped buying, the gold prices came down, So they went all the way down to $900, and then they settled at around $1,200, So gold from, let's say, 2012 till around 2020. So for this 7-8 years period was trading in a tight range, plus minus 10, 15, 20%. Obviously, you had the rupee depreciation. So in rupee terms, gold was still making money for people.
Okay.
But in dollar terms, it was not going anywhere. And then COVID happens. And again, the world goes into a crisis. US government, kind of monetizes the economy, infuses a lot of liquidity in the economy. They starts buying billions of dollars, trillions of dollars worth of gold bonds from the banks, and flood the market with liquidity, dollars. And so it created another uncertainty, and therefore gold prices started inching up. It was at around $1,200. It went all the way to $1,800, then to $2,200, I think 1.5 years back. And again, because after the this US kind of policies and everything, central banks again started figuring that it's better to shore up their gold reserves, because the balance sheets of more nations have expanded in this last 8-10 years. Like India used to have around $300-350 billion of reserves just a few years back, and now India is sitting on something like $800 billion of reserves. So as a percentage of the total forex reserves that India has, the gold as a percentage had fallen. So they started shoring up. And same happened with China and so many other countries, So this humongous central bank buying, which we have seen in the last 2-3 years, have again made sure that the gold prices have appreciated sharply. So in the last 1 year itself, in terms of dollar prices, gold has moved up by 50%. We have not seen that kind of moves in a very, very long period of time. And obviously rupee also depreciated. In during COVID time, I remember rupee was at around 75 rupees. Now it's at 85. So that again has made sure that Indians are benefiting more from this gold price surge than anybody else in a developed world.
Interesting. We hear about these sovereign gold bonds. What are they and how do they work and what's the impact?
So I don't know how many people know this, but gold is the second highest commodity that we import after oil. So oil we can justify, everything that we see around has oil derivative. This mic has oil, my shoes have oil, our clothes have oil, everything that we see around ourselves and consume has some oil derivative. So importing oil, because we are not a large oil producing nation, is justified. But gold is the second highest, and in fact, a large part of our trade deficit in India is thanks to this gold imports. If we had lesser gold import, because Indians have a penchant of buying gold, and in fact, that's the reason why we are doing this podcast in the first place. Even in normal times, the gold, the appetite for gold is never ending. So government thought that, okay, why if we kind of replace this physical gold with a paper and throw in a small return, to 2.5%. They promise that we'll give you 2.5% interest also. And if you buy 10 lakh rupees worth of gold bonds, we will return the equivalent value of gold to you on maturity.
Okay.
And so scheme had very good intentions. It wanted to reduce people's appetite for buying physical gold. It reduced the imports, that the now amount of imports that India is doing, therefore have more trade balance, which would have made our reserve bank's life a little easier. But none of this worked actually. So it was a well-intentioned scheme which has gone completely sour, because the mistake that the government did in its calculation was that they assumed that gold price will remain stable, and it has not. And so gold price has gone up some 3 times, and now you have to pay 3 times more, and there's no gold that the government bought to back these SGBs. If they had bought the gold to back the sovereign gold bonds, the whole purpose of the scheme would have been lost. So instead of I importing, the government is importing on my behalf, and it's also giving me 2.5% for safekeeping.
True.
So it would have lost. So there was but the entire calculation went wrong, and now government is looking at a big gaping hole in their balance sheet, because they will have to make good the promise, and which means there's a fiscal loss to that extent. A few lakh crores is going to go in maturities of these bonds whenever they mature. So now, of course, some sensible person has put a stop to these gold bonds. They have stopped issuing that. But whoever invested has been very lucky. They got 2.5% tax free, and then all this appreciation tax free.
Correct.
And so they don't have to pay any taxes, and they have tripled their money.
Interesting. So talking about this shift to investing in financial asset, which is gold as a financial asset, is that movement real?
So gold ETFs have become popular in India, and it's become easier for investors to take a bet on gold by buying ETFs than buying physical gold, because even the buying selling spread in physical gold is higher than in ETF. So when you buy an ETF, you buy the spot price. When you sell the spot price. So it's much more efficient. But that attracts only investors. The larger population of the country, we have 140 crore people, and I think even the poorest of poor will have some bit of gold in their house, and if they got more money, they'll buy more gold, so the larger population still is only attracted to physical gold. And that's been the case internationally also, that if you look at the amount of gold which is getting mined and which is getting recycled And if you were to look at the sizes of the ETFs, iShare is the largest ETF in the world, which is basically gold-backed ETFs. It may be a few $billion, maybe 30, $40 billion. It won't be a large sum of money.
Okay.
So most of the gold which is there is physical.
So, but do you think gold as a part of the portfolio should have a place, and how much should it be? How is the portfolio allocation around gold?
So as part of diversification, and obviously it is very difficult to tell somebody that gold will not do well, and I'll be speculating honestly if I say that gold will not do well. There are certain trends, that are emerging, and maybe I'll talk about them a little later. But considering what has happened in the last 20, 25 years, everybody wants to have a gold in their portfolio. My only submission is that, have maybe 5%, 8%, 10%. But beyond that, if you are having, then you are exposing yourself to an asset category where only demand and supply decides what will be its price. Today RBI is or central banks are buying gold. So you see this huge appreciation, from $1,200 to $3,200. In fact, it was $3,600. Now, last 2 days, it's come down. But the day they stop buying, the gold prices have to come down, so because it ultimately demand and supply. Today, there is more demand than supply. When the central banks stop buying, which is the largest component of buyers today in the marketplace, then supply balances with demand, or maybe supply outstrips demand, and therefore the gold prices will come down. And people need to keep in mind what happened in 2011 or 12. From 1900, the gold came down all the way to $950, $900, and so it can happen again. There is, I was just looking at some data yesterday. India, 5 years back, 5% of our gold reserves were, forex reserves were in gold. Today, that number has become 12%. Okay. Last year, Reserve Bank of India bought 73 tons of gold. And now that number, their total gold reserves have gone up by 850 tons or so. So just imagine 10% of their total reserves they have accumulated in just 1 year. The rest they accumulated over 75 years, So obviously this cannot go on forever, because every central banker also knows that if it has to sell even 1% of this gold, they have to find another central banker. Okay. They cannot sell this gold in the marketplace.
Correct.
Who's going to buy? Let's say 878 tons or something is the gold reserves. If they have to sell 1%, it is 8 tons, 8,000 kilos. Okay. If they have to sell 8,000 kgs tomorrow, who's going to buy? So they have to have a limit to how much gold that they can keep, while central bank, if gold was a perfectly liquid market, maybe they'll keep 20%, 30%. But because it's highly liquid, and there's a big difference between the number of buyers and the supplies and, the capacity of the buyers to buy, at some stage they will stop, So I think, people, if they have 5%, 8%, 10%, in the long term, because we see rupee keeps on depreciating by 1 or 2% each year. In the last 25 years, our depreciation rate has been around 4% per year. In the next maybe 10, 15 years, it will depreciate at 1.5%, 2% every year. So that 2% is assured. If gold price was constant at $3,200 over the next 10 years, then that 2% per annum, which is something like a 30-35% appreciation, if we look at compounded returns, is assured. Then it depends on what the international price is. And there you have no clue, on which side the market will turn.
So you mentioned about these demand-supply dynamics. Would you be able to elaborate that a bit more in terms of how does that impact the gold prices, and where do you see that moving in the future as well?
So look at it from the perspective of demand. Okay, who? So let's forget the central bankers for a moment. Their buying of gold is only tactical. They don't have any use for it. Okay, so who's buying gold today? Basically, people who want to invest in jewelry, or they think it's a good investment to be held for future. So somebody is buying gold in relation to a fixed deposit that they could have had, or they could have had a flat. Instead of flat, they buy a large sum of gold, or instead of investing in equities, they buy gold. So so basically there are two kind of people, investors in gold. One is a financial investor who's basically buying gold to profit from it, and second is a user. Basically, an average, a woman who likes gold jewelry and therefore wants to buy that, But if you look at, there's this new trend, and I'm sure, most of us are looking at this, that the youngsters of today do not want to hold these costly assets, So if a youngster was given a choice that, okay, you can buy a 10-gram chain and spend 1 lakh rupees, or you can buy 20 pieces of imitation jewelry, I'm sure she will pick up 20 pieces. So the penchant for buying gold is kind of reducing. 10 years, 15 years down the line, these youngsters will be in middle ages, and people like us who are in middle ages would have gone old. And we'll be off our earning years. So in any case, people who are today who are very enthusiastic about buying gold will be off their earning years, so they will not be the investor. 10 years down the line, 15 years down the line, and the investors of tomorrow, which is the youngsters of today, won't have interest in gold. So if you were to think about it, that the commodity where everything is decided between the number of buyers and the number of sellers, the quantity available as a supply and quantity which is demanded, if the demand comes down and keeps on going down, then what is the future of that commodity? So all this safe haven and all that may continue for maybe 2 years, 3 years, 5 years, but it will change. And I think people don't see this. This is the trends, when they are happening, people have a tendency to say that, that no, this is not going to change. It has not happened in the last 25 years. Why should it happen in the next 25 years? But it does. If today, if let's say just 15 years back, I would have said every single Indian in this country will have a computer in their hands. People would have laughed at me. Today, your mobile is more powerful than the computer which was there 15 years back.
True.
Far more processing power, far more speed, far more data storage capacity than a computer which was there 15 years. And that has come true. So trends do change, and people should recognize that this is also a passing trend,
Interesting. So how about the near-term rally? Where do you see that going?
So as I said, I think expecting last 5 years, I think gold has tripled in value. Okay, 1200 has become 3200, and rupee has depreciated by 15%. So it's almost tripled in value. What is trading at 35,000 is now trading almost at 1 lakh. And if you think that you will get similar kind of returns in next 5 years, I don't think that's realistic. So that is off the table.
Okay.
You cannot make substantial returns from investing in gold over next 4 or 5 years. And I'm assuming that based on that central banks at some stage in the near future will stop buying gold. If that happens, then you cannot. If central banks go crazy, and instead of today India has 11% as a reserve, if it becomes 22% after 2 years, gold prices will go up, So then you are, so it's all dependent on how much gold will central banks across the world buy. In my experience, most of them act with the same mindset. They are seeing the same data. So they react to the data in a similar fashion. All of them are intelligent people and they are ability to analyze. So they look at same trends and therefore react similarly. So if one central bank stops buying, chances are that most of them will also in quick succession.
Okay.
So I think that in the short term, I don't see much hope. I think, in fact, this latest rally in the last 6-8 months has been primarily driven by US markets, because of this trade talks and all that which were happening. Plus, so the uncertainty which it threw, and which is most of that is getting kind of resolved now.
Okay.
So probably world will have lesser uncertainties in the near future, at least in the immediate future, than what we have had in the last 2-3 years.
Now, moving on to the future, what should investors do? Anybody who has gold in their portfolio currently, what should they do? What should be the next steps?
So, if you have bought gold with a perspective of profiting from it, so you are an investor and you have bought it in the last 3-4 years, you are at a very good place. Okay, you have made 50, 60, 100% return beyond your imagination. I think, take that money off the table. Because if and we have discussed about central banks a lot, if even if there's a 10% probability that they'll stop buying in the next 1 or 2 years, the aftermath of that will be a sharp correction. Okay, so right now you are sitting at a good level. You are at an all-time high. You have made good money, much beyond your expectations. Take money off the table. If you hold gold as jewelry and whatever, continue to. There's no harm, and generally, whatever trends that I'm speaking in terms of sluggish demand in future and all that, that's only conjecture. That's my theory. May come right or not come right. Even if it comes right, it will be a very gradual shift. So continue to enjoy. So if gold makes you happy, and your jewelry makes you happy, continue to hold it and buy more if you want to.
Perfect. Wonderful. I think it was very interesting to understand the entire dynamics of how the demand supply works and how the speculative nature of the asset class impacts investors as well. So thank you so much for all these insights. It was a pleasure talking to you.
My pleasure as well. Yeah, thank you.